So government shutdown, kind of a tough deal, and we'll just see how it goes. But Jobs Week, which is interesting, which could actually be impacted by the government shutdown because if the Bureau of Labor Statistics is not open for business, they can't release a report, and then we have no idea if the job market is rebounding or if it's going to continue to show some weakness.
Expanding our money supply because the Fed has been restricted. I'm going to explain that.
Credit card loans, car loans, those are short-term borrowing rates, and they are low right now.
Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop.
Pete coming to you live from Corona, California. It is Monday night. It's a little late. I'm a little under the weather, so I apologize. But wow, Jobs Week, government shutdowns, and sticky inflation. Oh my, what a week. Is the government going to shut down? I don't think anyone really knows if they'll get a continuing resolution, which basically just says, hey, let's just keep spending what we've been spending. Let's kick the can down the road for like a couple months, and we'll just talk about it over the holidays. Anyway, I don't know if that's going to happen this time. And again, I am trying to get into politics and be political. But these things are always interesting because, we've had one that has lasted 35 days, but just kind of silly that like the way to get things done when you're not the party in power is to shut down the government. So, things are kind of humming along in this country. I mean, we've got, decent GDP. If you have a job, you're in a good spot. Wages keep growing at a healthy clip, and people are spending and consumers are confident. Now, if you're out of a job, it's a totally different animal. And if you are in, a lower socioeconomic part of our country, you're struggling right now, and things are hard. And I don't think government services or government shutdown helps them at all. In fact, I would feel like they get hurt the most. So blows my mind, but we're just going to sit back and watch like we always do. Could impact the bond market. You could see the stock market potentially sell off, at least short term. I am not a financial advisor, not responsible for your losses, only your profits. But typically money tends to flow around. If stocks sell off, they tend to go into bonds. That's usually rate friendly. I'm not sure if that will happen, even Wednesday or Thursday, maybe by Friday if there's no progress made. I did see that there are people in DC getting together, just little clips here and there. I'll have to get on CNBC in the morning and see if any clips come across. I don't watch TV, but I watch clips on YouTube. So not a TV watcher, although I did watch the Cowboys game last night. It's like one of the only things I watched, like Cowboys and Longhorns game. What a game, 40-40 tie. It's like kissing your sister. Gina, I know you're out there. I don't think we've ever kissed, even when Dad passed away. So I don't think I've ever had a tie. So government shutdown, kind of a tough deal, and we'll just see how it goes. But Jobs Week, which is interesting, which could actually be impacted by the government shutdown because if the Bureau of Labor Statistics is not open for business, they can't release a report, and then we have no idea if the job market is rebounding or if it's going to continue to show some weakness. Remember, this jobs report is the September jobs report, which comes out on the first Friday of the month. It's really not the whole month of September because you can only collect data so quickly, as we know. There's a bunch of surveys, household survey, establishment survey, takes a long time. We still do surveys, don't know why. 60% return rate, they take 90 days or more. Some people don't return it ever. So anyway, it's like the second half of August and the first half of September kind of data coming in. But, it's like that every month. So there's a trend. But there's always a revision for 2 months prior and 1 month prior. So we will get a July and August revision if the government isn't shut down and the BLS is putting out the report. And that always moves the markets, even though it's the fake Friday jobs report, which gets revised by the QCEW later and comes to find out that, just kidding, half the jobs we thought were created for an entire year weren't actually created once the states showed us their employer records for insurance for each employee. Anyway, Jobs Week's a big week. Case Shiller Home Price Index comes out tomorrow, so we'll see how things are doing. We know there are some states that are oversupplied, and the whole existing homeowner market has been coming online a little bit this year more than normal. Kind of getting, I've been saying this for a couple of years, like this mortgage rate lock-in, it will only last so long. But as you grow equity over time, you're like, hey, it's time to trade that equity in and go buy something else. And so, the 7Ds, they're constantly happening. Deployment, diamonds, diapers, debt, divorce, like to say debt a second time after divorce, can't say that again, downsizing, and death. Some people like to throw in diplomas too. Not sure about that one. Not 8Ds, 7Ds. So something about Mary reference right there, the 6-minute abs. So anyway, people will trade it in. And some of these existing homeowners have had what I think are unreasonable, just kind of taking a litmus test and seeing the price cut data that's out there, have had unreasonable prices they want to sell their home for, and they're kind of coming back down to earth. I had a conversation with a realtor who helped me lease one of my properties, buy and lease a property, and in Orange County several years back. And he's like, I'm in this conversation with a person who wants to list, and they just have this unreasonable price they want to list it for, and I'm trying to tell them the right price to list it for that will get it sold, not the pie in the sky number to make them feel good to win the listing. And so he's trying to do right by the consumer, and I'm trying to well, tell them this and tell them this, show them this data, show them that, show them the price cuts, show them the inventory. But it's kind of tough, existing homeowners like, well, I know what my house is worth. I saw it on Zillow, or I saw it, that one house, the white elephant, it went for this much. So I can get X. I simply do the price per square foot. I do it times mine, and that's what I think I can get, maybe with a little bit more. And then it doesn't sell, and the realtor is the bad person. So it's very interesting. We're starting to see some coming back down to reality, but we're also starting to see some movement. Lower rates have been helping. We've had really low rates. I'm sure, from the C-suite, just an executive here, an owner, and just trying to share something that I don't think is, unique to us, but a lot of us lenders are experiencing really good lock volume in the month of September, 50 to 60% up from August. So October fundings have a chance to be the highest funding month with the most communities served of the year for most of us. And that's a nice breath of fresh air. We're looking at, maybe 30% refinance business. So that's a nice little jolt there. It's good to help lower people's debt service ratio at home, give them some more cash in their pocket, which then, of course, could boost our GDP further going into 2026, get some confidence. If the stock market keeps doing generally well, there's a wealth effect. Remember, you can build wealth in the stock market. You don't have to be wealthy or rich to just put a little money aside, just a little, like $5 here, $10 there. It adds up over time. Time in the market is what matters. If you're not in the market at all, you're not getting any wealth effect from that asset class. And it's not as hard as you think. Anyway, we should get FHFA home price index tomorrow as well. And that is just on conforming loan amount. So Fannie and Freddie loan amount. So a little different price appreciation number there. JOLTS report, job opening, labor turnover. That's big data that comes out. And ADP report will come out. I believe that's Wednesday. And jobless claims Thursday. And then, of course, the BLS jobs report. Again, all that is off the record and not going to happen if we have a government shutdown. And what else will happen? I've been telling people for a little while now, get your flood insurance ordered in case the flood insurance fund, the NFIP, doesn't get funded. And then you can't order flood insurance. I lived in Fort Lauderdale for 13 years and a lot of properties in flood zones, and it's a requirement. So, tomorrow's your last day, potentially. Hopefully this government shutdown doesn't happen or doesn't last too long. My guess is, this is my guess, is we're going to last into next Friday. Not this Friday, but next Friday. That's my guess. Will the CFPB see a bunch of firings tomorrow? There was a green light from some of the court cases there that the administration has the right to let people go. And how will that impact the markets? Will that be seen as, 1,400 people get let go, which is sad if it happens tomorrow before the October 1st deadline, because if they're still employed October 1st, then they get paid and then get furloughed and get back pay. So everyone, we don't save money. We keep having to pay everyone that works for the government. So how will that impact our business? Will all the articles about state regulators, be coming out in full force once that CFPB action potentially happens tomorrow or this week? So those are some things. NBA did a great job. They're trying to lobby for insurance, flood insurance, to be kind of set out separately, but unfortunately can't get anybody in the Senate to the table and get things done. So they seem pretty far apart. They didn't get to go to work last week. We had the Rosh Hashanah to Yom Kippur holiday. So, there's an old adage says, they say, sell on Rosh Hashanah and buy on Yom Kippur. That's supposedly after the holiday, this coming through the end of this week and weekend of Yom Kippur, that the stock market starts to rip, although October is kind of weird and wonky. Anyway, lots going on. Social Security, not really on the docket for a government shutdown, but we have a cost of living adjustment that's coming out. I believe it's October 15th is when that's coming out. So I read this. This is a LinkedIn in the know, kind of a LinkedIn news feed that I got. It said, this article said that October 15th, the Senior Citizens League predicts a 2.7% cost of living adjustment. Seems kind of low considering everyone keeps talking about inflation. Speaking of inflation, 0.23 on the core, 0.27, I think, on the headline number. So as expected, although still sticky, slightly rising. And, it's very interesting. You watch our friends at MBS Highway, they talk about the trueflation number, which has a more real-time data as opposed to looking at a number 12 months ago and using it as a barometer for today's data. I understand why the Fed traditionally does that, because they like to have like the ups and downs kind of smoothed out over a 12-month average. But like if jobs start to break a little more and labor starts weakening, obviously they can move quickly and they can, cut rates further or faster, in more meetings if labor is breaking, if they feel like labor becomes way more a problem than inflation. But you get mixed signals from all the Fed speakers that come out and start talking. But the trueflation number went from 2.2% to 2%. So we're at 2%, but not according to the Fed's data. And all their data is great and holy and completely amazing. And speaking of data, and speaking of the CFPB, AI is a big topic. Had a prep call for the IMN AI Summit that's coming up in Dana Point next week. So all my travel starts kicking off, going crazy. Be at the Stratmore MBA PGR, peer group review. It's in San Diego, looking at data and trying to plan for the future and see how things are going. And then go straight from there from San Diego to Dana Point and moderating a panel with some great guests talking about AI and how we can use it. In all these companies that are in AI, there is a metric that's out there that is revenue per employee. And it seems simple, but it's talked about a lot because if you look at NVIDIA, it's like the quintessential poster child of revenue per employee. $4 million in revenue per employee. I think the next best is Google at $2 million. Now, if you look at CFPB, counting some of the settlements they've had for like $8 billion, the credit card fees and all this kind of stuff, I mean, if you look at their revenue per employee, it's actually pretty high if the stuff didn't get vacated and if it got collected. So I don't know their number. I know Ginnie Mae, the Common Security Securitization Platform, those companies, government entities, revenue per employee is high. So it's a great metric. Just pinged our CFO and 3 partners and said, hey, we have our senior management meeting on Monday. Let's get a revenue per employee metric. I might not share it with y'all, but I do advise that we should do that. Also on a panel at the MBA annual. And so I know everyone's kind of planning all their travel. The next few weeks are going to be brutal. So after Dana Point, get the panel done, hop in the car, go to John Wayne, go to Texas OU, hook 'em horns, had a bye this week. Maybe Arch will prove the haters wrong. Have a great week. Cheers.
Hey, it's KP coming to you live from Dallas, Texas. We are in Addison having a team dinner here. Don't worry, I am not being arrested. We just happened to park. I think they're grabbing some drinks. Anyway, it is jobs week. It's also FICO big announcement week, which is pretty interesting. I'll get into that. I have some pretty good insight on that about, credit scoring, reporting costs, and all that kind of thing. But let's talk about the government shutdown and jobs week. So the government's still shut down. We're going into day 3 tomorrow. It's still Thursday here. And we are not going to get a jobs report. And so the first Friday of every month, we get the Bureau of Labor Statistics jobs report. We're not going to get it tomorrow because the government shut down. It's fake anyway, and it moves the market, but then it gets corrected like a year and a half later. So maybe it's just as well. But we know the trend. The trend is for weakening labor. So that puts a little more emphasis on the ADP payroll report, which came out negative 35,000 jobs yesterday. The Challenger jobs report, which is interesting. There are more job losses this year to date than there have been since 2020. It's like over 900,000. And there's less job hiring year to date. Just a little over 200,000 job hires. And that's the weakest stat for that since 2009. So I know it's not the tier 1 data point, but there's definitely weak reports out there. I would caution that the BLS report, when it does come out, it could be positive, which of course would send interest rates back up, just like a year ago when it happened. But the trend seems less likely for it to be positive. And of course, we have no idea when it's going to come out because the government's still shut down, and they seem to be really far away on whether to add $1.5 trillion in expense to our budget and our debt and deficit, or whether just to pass the budget as is just until the end of November. So they're trying to figure that out. Hope they do. So anyway, someone said that because the other jobs reports, like the ones I just named, Challenger and ADP, are the only ones we have to look at and they're weak, that would make the Fed be more likely to cut because they're weak. But it could actually be the opposite, just a contrarian thought, which not just to be contrarian, but I think makes a lot of sense. Because they're so data dependent and the data isn't out and they don't have the data, they may pause on the scary October Fed meeting 2 days or a couple days before Halloween this month. So because we're not getting the jobs report data and because we're not getting data, they may be likely to pause rate cuts. So that's a hot take. Okay, FICO, let's talk about it. I've been pretty in tune with a lot of what's been going on. I mean, you guys saw my video last week. I'm on the ZDI Customer Advisory Board, incredible company. And they did something last year where they created a what-if simulator as part of their Xactus 360 offering. I mean, they're not just a credit reporting agency. They have so many verifications, so many products. But they built this what-if simulator together with FICO and on using FICO information. So Xactus has had a pretty good relationship with FICO. And so this announcement today doesn't exactly come as a shock to me. I'm not saying I had any prior knowledge, but I'll just say that, FICO was $3.50. And then a couple years ago, it was $4.50 or $4.75. And it became $5.50. And everyone in the industry is like, if they're going from like $3.50 to like $5.75, why is my credit report going from like 20 to 80? Well, it's because there are people in the middle. And so whether it's the bureaus or an agency you buy credit reports from or whoever, there's a lot of hands in the pot. So again, not a shock that FICO, who's taken a lot of heat, by the way, and myself included, but it's I think the level of how much heat you give them, I think people are starting to realize they're trying to be a partner to the industry and help us save money on 82% fallout. 4 out of 5 credit reports pulled do not become a funding. So there's a lot of money being spent. So everyone has to come up with all these different workarounds and processes. They're spending a lot of money on credit reports that don't have revenue to offset it. And then the 1 out of 5 loans that you do have that funds, you got to charge a lot more to the consumer to make up for all 5, right? It's like a bundled pricing together with all your other technology and verifications and stuff. So it's been a challenge for the industry. And so it's nice to see FICO make the announcement. I don't know how DUNLP can be run with that credit report. I don't know if there's going to, what Xactus together with FICO are going to do, but I'm really excited to know that there's definitely some changes and our voice being heard, to make some improvements to cost. Consumer Direct is 8% pull through, right? So 9 out of 10 credit reports go to nothing. Imagine some of the bills for credit report that some large consumer direct companies pay. I mean, it's astronomical. So that's all taken out of borrowers and consumers' pricing and or charged to consumers. And we got to figure it out. So interesting announcement. Obviously, there'll be more to come on that, I'm sure. Okay, so Case Shiller and FHFA home price appreciation numbers came out as expected. It's slower home price appreciation. It's like 1.9% down to 1.7%. But that's also numbers from, I believe, July or August. I apologize. So we haven't really seen the full effect of the low interest rate environment that we've had here for the last, really since the July 3rd jobs report, rates have been getting really low, and they're still pretty good. I think the 10-year Treasury today was at 4.08. I know that's not the only thing that measures interest rates, but it is, it is easier to explain the 10-year Treasury yield than it is the mortgage-backed security market and securitization to a consumer. And for simplicity's sake, we're just going to talk about the 10-year Treasury all the time here. Okay, so it's not a misconception that I read somewhere in the press that the 10-year Treasury is the thing. It's just an easy talking point. So 10-year Treasury yields, I think it was 4.08 today. So rates are still good. Locks are up. I think people are feeling good. And I could just say that, let's make hay while the sun shines. Again, if we had a jobs report tomorrow, if the government was shut down and it was like 130,000 or 140,000 jobs created, rates would shoot up. And poof, just like a year ago, there goes our low rate environment. So I've been talking to lenders. Nexa Fest is happening over here, and talk to some other peers of mine that have lenders, and everyone obviously locks are up. So we're all just very thankful. So yeah, our locks are up about 60%. Let's clear out the pipelines. Let's give people liquidity. It's 30% refinance activity. Some people are seeing more than that. So there's still a good, healthy amount of purchase activity as well, even though it's not seasonally the purchase time of the year. Like, we're right in the middle of fall. Like, hey, let's move right before Halloween and Thanksgiving and Christmas and Hanukkah and all New Year's, all things. So anyway, I'll get back to y'all next week. Have a wonderful week and weekend, and let's go help these communities at the highest levels. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.